Hello, everybody, and welcome to the Vancouver Resource Investment Conference channel. My name is Jesse Day. We are bringing the VRIC to you each and every week with our series of expert online panels, and we have a fantastic one lined up for you today. We've got David Rosenberg of Rosenberg Research and Michael Gayed of the Lead Lag Report. Gentlemen, it's great to have you both on the show with me today.
It's kind of you to call me an expert when I'm going to be with Mr. Rosenberg here. I appreciate that way of introing.
Well, Michael, I think we spoke just a week or two ago, and I would actually defer to you as an expert. Jesse, thanks for having us both on.
Yes, thrilled to have this panel. I've been wanting to have both of you on the channel for quite some time. To be able to combine you is excellent. You know, there's a lot going on right now in financial markets and the global economy. All of this information is getting accelerated by social media, of course. But I'm wondering what the main things that you're focused on right now that are driving your investment decisions, maybe some factors that you think more investors should be paying attention to. And Michael, I'll start with you on this one.
It's funny you use the word, what are we focused on right now? Because I think the thing to focus on is the lack of focus by the
Yeah.
investment community. I mean, I'm blown away how we went from nobody heard about the reverse carry trade. Suddenly everyone's an expert. It seems like the end of the world on Monday of last week. And then, oh, I guess the reverse carry trade is done and we're back to pushing for highs here. I am legitimately blown away at the speed with which the narrative changes. Now, narrative always changes according to price, but the way that the sentiment just shifts so aggressively, I think, and I think, David, you can add some interesting commentary on this. I don't think we've ever seen that in the way that we're seeing it here. So I say that because I think the thing to focus on is the same thing that everyone was focused on that everyone forgot about, which is still Japan, in terms of this reverse carry trade being, in quotes, finished or not. You don't unwind something that's been going on for a long, long time in the span of 48 trading hours. And we haven't obviously heard or seen anything yet, but typically when these deleveraging shocks happen, somebody's probably going under, right? And you only know about that months later, right? Because it takes time for that butterfly flapping its wings, or in this case, in the case of Japan, Mothra, to create the hurricane. So I don't think anything's really changed in terms of my own personal focus. I'm still very much of the mindset that we're going to have a main event, the main event being credit spreads really widening aggressively. This may still just be a calm before the larger storm, but hey, I could be wrong. I am not a perma bear, neither is Mr. Rosenberg, so don't brand us as that. But I do think that it would be foolish not to focus on what should be the big focus.
Quick break here. This episode is brought to you by West Red Lake Gold Mines. Now, if you know nothing about West Red Lake Gold Mines, let me tell you one thing. This company was founded on the back of a transaction where they purchased the Madsen mine in northwestern Ontario in an area called the Red Lake Gold District, which to date has produced around 30 million ounces of gold from some of the richest gold deposits in the world. Now, what they paid for this mine versus what they got has led legendary mining entrepreneur Frank Giustra to call this transaction the deal of the decade. And Bob Moriarty, founder of 321 Gold, was recently on my show calling West Red Lake Gold Mines one of the two most undervalued gold companies in Canada. If you're curious why these individuals are so excited about West Red Lake Gold Mines, hit the link below to learn more. Now back to the episode.
Yeah, very well said. And people were panicking on social media, proclaiming it Black Monday. And here we go. The whole market's going down. David, what are your thoughts on the comments Michael made about, those 48 trading hours, the kind of panic that ensued? Is this a blip in the radar? Is this signs of systemic weakness that could lead to a larger correction moving forward? And anything else you're currently watching when it comes to markets and the economy?
Well, I think that there was a fundamental shift that did take place. I think, as Michael had mentioned, after really not just years but decades of leverage investments being put on across risk assets premised on the end carry trade, which was very lucrative because you were guaranteed to be borrowing in a very cheap currency with rock bottom interest rates. And what the Bank of Japan did, I think most people thought they were going to start to firm policy at some point, but they came in earlier and went more than people thought. And then the BOJ sort of stepped back and gauged the reaction. It was a delayed reaction, but it was a Black Monday, certainly in Japan. It was, I think, their worst day in since October '87, and I think one of the worst days they had since 1950. And it reverberated around the world. And the next thing you know, one of the senior BOJ officials come out and said, "Well, don't worry, you're not going to get a steady diet of rate hikes, and we're going to sit back and assess." And so the markets always focus on what central bankers have to say, and that provided, some renewed calm. We're not really totally through this. I think a lot of this leverage trade got unwound in spectacular fashion, but it's not completely unwound. And there's no doubt that if there's a real reversal taking place, it's going to be in the Japanese yen, which, at one point was heading to 160. And I think that if you look at any fair value estimate on where the yen should be going, it's between 100 and 120. So this support mechanism for risk assets that we took for granted, that part of it is over. So that's the way I look at the situation, that a prop for the risk on trade has been removed. It doesn't mean there's not other props in animal spirits or animal spirits. That's what influences the stock market, which is why we have these lofty multiples. But the real economy is something totally different. And I think that if there is a concern, it's that we are starting to see some fraying at the edges, excuse me, as far as the US consumer is concerned. Not yet an outright contraction, but you're starting to see a real significant shift in the pattern of spending, and not just by the low end, but now the middle end consumer, in terms of trading down and spending less per visit, no matter what they're doing, whether it's theme parks or restaurants or even travel. Spending per ticket item is starting to not just decelerate, but in some cases contract. So getting messages from the consumer sector, almost 70% of GDP, that we're starting to see some real signs of weakness come to the fore. And my focus, just like the Fed, has switched towards the cracks that we're seeing emerge in the labor market. So I think all roads are leading towards what the missing link has been for the past, you can call it, year and a half, through this period of an inverted yield curve, which we know, exerts lags that are long and variable. This has been one heck of a long lag, but we had that back in 06 and 07 too, coming off that Fed tightening cycle. So I think that the narrative is going to be in the next, say, 3 to 6 months, is that the recession that people thought we had averted is going to come back into focus. That's my sense.
I would add real quick.
Go ahead,
Just an interesting observation on the consumer side. If you look at the chart of DraftKings, which to me is an interesting tell on sort of sentiment around consumers' ability to spend, because it's about gambling. It never really took out the prior peak, but it's clearly rolling over since March. So if you use that as maybe a little bit of a signal or tell on expectations around the consumer, that's kind of ominous. And I'd add that I suspect that if we're at the start of the credit spread widening cycle, when we look at most junk debt averages, high yield investments, the top 3 sectors tend to be industrials, energy, and consumer discretionary. I haven't actually looked too deeply recently, but I would suspect that the widening may be starting to accelerate on the discretionary end of the high yield bond space, which then could spark broader widening across other sectors.
Well, I want to go down the Japan market rabbit hole a little bit, because I know you both have a ton of knowledge with that country's market. Now, the yen carry trade, this is something that, Michael, as you mentioned, has popped up a lot on social media. You've been talking about it for quite a long time. Maybe you could first start by giving us a definition of what the yen carry trade is, because not everyone is aware of that, how it affects the market, why people think it was behind this recent correction, Is it connected to the drop in the Nikkei and the rise in the yen at that point in time as well? If you could give us some details there.
It is all connected. That's the thing with this stuff. I've been adamant about this since August of last year when I first brought up the point. I mean, at the core, this is ultimately about a monetary cycle mismatch between every other central bank raising rates and Japan not doing so, which has widened the interest rate differential, caused the yen to keep on weakening, and resulted in a lot of borrowers overseas saying, why in the world should I borrow money in Europe or in the US when I can get it basically free in Japan? So at the margin, that's what the carry trade is. You borrow incredibly cheap money in Japan, and because money is global, you put it somewhere else that's earning more, whether it's T-bills or into speculative areas like the Qs or the NVIDIA trades of the world. I always still saw that as an interesting risk. Now, it's a little bit of a more complicated thesis that I had back then, which people are now starting to talk about, which is to say that if you're borrowing it in yen, you as the borrower like when the yen is weakening as your currency is strengthening relative to the yen, because it means when you pay back that loan, you're not paying as much relative to your own currency because of that yen weakness, which means it's a tailwind, right? It actually adds to your total return. The dilemma is what happens if the yen strengthens, right? Now that fixed liability loan in terms of what you're borrowing from Japan is more expensive because of the currency conversion, because now your currency is weaker relative to the yen. And my whole thesis all along was Japan will panic. At some point, they have to push the yen higher, squeeze out the speculative shorts because they import all of their oil. If they do that, that starts causing some panic among those borrowers. That results in them having to sell where they deployed that carry trade leverage into, which includes US stocks. And that creates a bit of literally a technical margin call, which I think is you can argue what we saw, Friday to Monday when everyone freaked out. The key there is that it creates the volatility, which then sparks credit spread widening aggressively. So to me, it's less about Japan. I've always argued that Japan is more of a spark to credit spreads widening because there's a direct correlation between volatility in US equities and credit spread movement. Credit spreads are basically equity vol from that standpoint. So I still think we're very much early in that process, right? And just as everybody is now focusing on Japan, I would go back to that's now actually the distraction. You've already started the pebble going down the hill, and if I'm right about the whole thesis to begin with, the main event is really credit spreads blowing out as a result of this being the spark.
Well, let's stick with the distraction for just a little bit longer because, David, I know you've been following the Japanese market for a long time now. Were you surprised how quickly the Bank of Japan capitulated in the face of this drop in the Nikkei and proclaimed that they would no longer be raising rates? And how do you see the market in Japan today? What do you see more weakness in the Nikkei up ahead, or is this a dip that will then recover? Is this a buy the dip moment in your view? What are your thoughts?
Well, I'm still a secular bull on Japan, and I've written many reports showing that constructive narrative was not really premised on a cheap yen or even very low interest rates, although it certainly helped give the Japanese market a superior equity risk premium compared to the rest of the world. I don't think that the Bank of Japan is going to go wild on rate hikes like what Jay Powell did. And of course, Jay Powell was also battling completely reckless fiscal stimulus at the same time that the economy was reopening. But it is a shift. The yen strengthening creates winners and losers, and the losers you would think would be the large cap export-oriented manufacturers. But as Michael had mentioned, Japan might be a large exporter, but it's also a very large importer, and they don't have natural resources of their own, including oil. They import it and priced in US dollars. So you see the strengthening of the yen is going to be a tailwind for consumers there. It's going to give them more real purchasing power at a time when nominal wage settlements are now going up at their fastest rate in 3 decades. So, the export sector in Japan might be, 20% of their GDP, But consumer spending, and look, they're not America, but consumer spending there was more than twice that share. So I think it's a net positive. It creates winners and losers. I think rising rates will give the banks some much needed net interest margin. And like I said, the laggards will be who the winners were, which were those companies that are export oriented that benefited from all those years of a cheap yen. So that doesn't alter my view. Yeah, we had a massive reaction. It was a shift that you can see that a lot of people weren't expecting. A lot of short covering in the yen. And it generated, all the equity markets globally, you have these arteries connected to each other. So it did have a global repercussions. But it was the Japanese market that took a most on the chin. Yeah, worst day since October 87. In October 87, you had a bunch of things going on in the US. You had an overheated economy. The Fed back then, Volcker transformed into Greenspan at the head of the Fed, and Greenspan right away started hiking rates in the spring and summer of 1987. And then you had over a 20% collapse in one day. And everybody thought it was Armageddon. We would be having back then the same conversation for different reasons. And would you have told your clients, yeah, I'm turning fundamentally bearish on the US stock market because we had a horrible cascading decline in one day. And if you were bullish on October 1987 or October 20th, you were carried out in a gurney, but that was the right call. The fundamental bear market didn't really end for another 13 years. So I look at the Japanese market. How many other markets globally are trading at a 13.5 forward multiple? And the math in Japan works when you do the comparison of where the JGB yields are even now and where the earnings yield is on the Japanese stock market. You look at the all-in yield, buybacks and dividends, and it's one of the most compelling markets in the world just on a valuation basis, let alone the fact that the legacy of Abenomics and the shift in corporate governance and the pressure that companies are to get idle cash off their balance sheets. And in Japan, unlike in America or even somewhat in Europe, there is no equity culture in Japan. The equity culture in Japan looks like what it did back in 1981, 82 in the United States. The Merrill financial advisors told me when I was at Merrill, the ones that were around in the late 70s, early 80s, said that by 1982, if you were a Merrill broker and you cold call an account, you'd have the police showing up at your door. So, Japan has one of all the industrialized countries has about the lowest share of household assets in the equity market. A lot of the buying has been from foreign investors. So I think that the Japanese market has been a great place to be. It's up until this massive correction, it was actually outperforming the S&P 500. Nobody seemed to even know that. However, I think that it's trading like 7 multiple points below the US at much lower interest rate comparisons. And the list just goes on and on. So if you're asking me, do I look at this massive correction in Japan as a buying opportunity for people that are not myopic and obtuse, but actually have a longer term investment thesis? I still think it's got one of the most attractive upside return potential of any stock market on the planet. That hasn't changed.
Can I ask you, David, because I think this is interesting. When I hear that argument around the consumer side for Japan, it makes me think, and exporting versus importing, it makes me think that maybe the way to play it the next round is through the small cap Japan side as opposed to the large cap Japan side, because large cap is much more export driven. Is that a fair way to think about it? It's sort of like a rotation. If you're going to be playing Japan, maybe play the smaller end of things.
Yeah, I would tend to agree with that. The large cap exporters would tend to be the dominant force in the Nikkei. You can buy the topics. A trade might be to go long the topics and short the Nikkei because the topics is a much broader index, less export sensitive. So there's different ways you can play that. But Michael, by and large, I would tend to agree that the small caps that are more domestic demand oriented, that would be, I think, a wise choice of options. Absolutely.
Well, let's talk about the recession question. It's a horse that's being beaten to death, but we'll keep beating it. The economic indicators for a recession are flashing red everywhere you look, an inversion of the yield curve, etc. the mainstream financial media seems to still kind of be in a situation where they believe a so-called soft landing is possible. Are we likely already in a recession in your view? Because very often these things are not acknowledged until after the fact officially. And what are the implications of a recession for the investment landscape at present? Michael, I'll start with you.
I think it's nuanced. First of all, nobody cares about economic indicators saying recession until the S&P is down 10-15%. Then the narrative changes to, oh, it was a recession. That's what equities are now being priced off of. I keep going back to this Gallup poll from, I think it was a month and a half ago, where 3 in 5 Americans said we're in a recession now. Which is why this is nuanced, because to a lot of people, it certainly feels like a recession because of this K-shaped economy that keeps on getting wider and wider in terms of the very wealthy and everybody else. It will feel more like a recession for everybody else, and the wealthy if asset prices go down heavy, because you need the reverse wealth effect to stop some of the consumer spending by the very asset-heavy owners, right? Who are basically saying there is no recession coming, or not one that they worry about. Look, it's not whether it's unemployment rising or people needing to take on 5 jobs just to be able to afford milk. The effect is the same, right? In terms of economic well-being, it doesn't have to be an outright recession to feel like one.
Yeah, that's very well put. People's day-to-day lived experiences is not necessarily connected with a bunch of economic indicators and talking heads discussing it. David, your thoughts on the recession question. Are we in a recession? How does that change your own outlook when it comes to making investment decisions?
Well, it's an interesting question because the Wall Street Journal today contained an article on a new and improved employment indicator that showed that there's a 40% chance that a recession started in March. Now, 40% might not sound like a high number, except for the fact that there's no asset class out there even priced for 10% of a recession call. Whether you look at credit spreads, high yield spreads, the multiples in the stock market are pricing in pretty well 0% chance of a recession. Maybe the bond markets got it sniffed out. Maybe some of the action in the commodity markets, they've only bounced recently because of what's happening in the Middle East. But when you're taking a look at the risk on trade, does not have recession on the scorecard at all. So this will come as a bit of a surprise. From my vantage point, it's timing the recession is as difficult as timing the peaks and troughs of the market cycle. It's really next to impossible, and it's even harder when it comes to the economy, because all the data that we get today, even GDP, retail sales, the housing indicators, and non-farm payrolls. Non-farm payrolls, what you see is not always what you get. Non-farm payrolls have been revised down in the past year, 3/4 of the time. And the same will happen with GDP. And so it is interesting because when you go back into history, and I won't go back into like the past century, but the recession we know started in the first quarter of 2001. That was the tech wreck recession. But that the government data showed in the first quarter of 2001, real GDP was positive that quarter. But what happened was that when you look at the numbers today with a more complete sample of what goes into the economy, it's now negative. And that's when the NBER finally targeted the first quarter of 2001 as the start of that recession. That was a tech wreck recession. And you go back to the Great Recession, and everybody thought it was a soft landing, even after Bear Stearns went down for the count and got gobbled up by Jamie Dimon, because that's what he does so well. And people thought that we were in a soft landing into the summer, if not fall of 2008. And everybody was pointed at look at the positive first quarter GDP 2008, but yet it got revised and now negative, as we know. And people were shocked to find out that when the NBER finally made the declaration of the recession in December of 2008, people think they're a bunch of dummies. But remember that back in the spring and summer, nobody thought there was a recession. But of course, the NBER, who are the arbiters of dating when the expansions begin and end, and the same for recessions, they wait for all the revisions to come in. And so we know now that that first quarter 2008 that had a positive glow was negative. And today the problem that we have as economic prognosticators is that in the post-COVID world, the response rates to the government on all the data, the initial response rates are far lower than they've been in the past. And a lot of that is because of small businesses are just taking longer to get their data in. So it forces the government statisticians, it's not a conspiracy theory, it's just that they have to make a lot more assumptions. So I say what you see necessarily isn't what you get. So you see the revisions still have to come in. People say, well, the yield curve's been inverted for like almost 2 years. Nothing's happened on the economy. But we don't really know because the first go around and all the data have a low sample size, and then we're reinforcing that with very low response rates. And so the data, I think we have to handle with a grain of salt, which is why I was very heartened at the beginning of the year, or the end of last year, when Jay Powell said at the podium after one of the FOMC meetings that we're starting to spend a lot more time on anecdotal data, the survey data, and of course the Fed Beige Book, which he referred to again when asked just a week and a half ago, or I guess it's going on 2 weeks since the last FOMC meeting. He came out and says, I love the Beige Book. And look, the Beige Book goes back 60 years. The thing about the Beige Book, it doesn't get revised. It doesn't get seasonally adjusted. And it is the most widespread, comprehensive view of the US economy, and it gets updated every 6 weeks. And when you look at, you do your own, we're putting a lot of money into AI and coding and machine learning. And when you look at the Beige Book, it's showing us that about half the economy right now is either completely stagnating or contracting. So I guess you'd say, well, but it's the other half of the national economy that's hanging in. But if you look at it on a diffusion basis, the dispersion of economic activity is deteriorating. And we'll only know with the passage of time and all the revisions as to whether or not the recession actually has already started. I would say that looking at the gamut of data right now, it would tell you that, yeah, maybe there's a 40% chance the recession has started, but it's not like 80%. Nothing's to say that that might not end up being 80% when all the revisions come in. But what I will say is that beneath the surface, beneath the veneer of real GDP, we are seeing more cracks emerge today than we have any other time this cycle. And I include, by the way, the headline negatives that we had in the first half of 2022, which was just mostly an inventory story. This comes down to exactly what Brian Moynihan said on Face the Nation on Sunday. And I thought this was absolutely critical because the bank CEOs, to a T, are economic cheerleaders. And Brian Moynihan on Face the Nation said, not only is the consumer slowing, now he didn't say contracting, he said slowing sharply. And he said, and I said at the beginning, that what he's noticing, because everybody's talking about, especially the pom-pom bearing rose-colored glass that never see a recession when staring in the face, are saying, well, don't worry because traffic is so high in restaurants and theme parks and travel. The traffic. Well, I got news for you. Traffic does not go into the economy. Walking in the malls does not produce economic growth. Shopping does. And he said that, and this is the recessionary signpost, he said that spending per ticket, spending per unit of traffic is going down. And by the way, that is what most of the retailers are telling you. If not telling you that already, they're telling you that that's what they see staring them in the face, like Home Depot just did with very weak guidance. So I would say this much, that the stock market has been breathing the fumes of the generative AI trade, and a lot of that is speculation. And we've seen that before, and animal spirits and jubilation over this inflection in the technology curve. We don't really know. We're just guessing. What is the TAM going to be for generative AI? What is the total addressable market size going to be? And that's pure guesswork, but the market always shoots first and then starts doing the homework later. Let's get ahead of this trade before everybody else does. But what we do know that gets very little attention is that the consumer discretionary space is down almost 2% year to date. It is the only sector of the S&P 500 that is in the red so far this year. Nobody notices because it's barely more than a 9% share of the market cap. But you see, discretionary spending in the economy is 40%. Discretionary spending in the consumer is fourfold important for the economy than it is for the stock market. And the fact that it's down year to date is a big red flag in the face of all the macro bulls who somehow believe that because a recession hasn't happened yet, it's never going to come. It's like me sitting here in Toronto saying, hey, in December, didn't snow, therefore winter's been called off. Think of how crazy that is. But that's what people are saying. So I would say that we're getting more emerging signs now, not conclusive, more emerging signs that recessionary pressures are building beneath the surface in the most critical part of the economy, which is consumer discretionary spending. Okay, consumers, in a recession, you don't cut back on utilities, you don't cut back on rents, you don't cut back on food. You might eat out less, but you eat in more, and you don't cut back on healthcare or education. But it's the other 40%, the stuff that you actually don't need, but actually is a very big part of the economy. That's the stuff that causes the recession. And I think as per Brian Moynihan, with his database of 60 million consumers, I think that the signs are actually getting there. So, and I would say that people are going to be in for a big surprise because people talk about a recession. Indeed, nobody's really positioned for one. And that's why any signs of recession. And that's exactly what happened on Friday. Remember, you wanted to talk about Japan. Remember, before Monday, we had Friday. And we saw how the market responded. Stock market didn't like the bad news on the labor market. Okay? That was not a case where bad news was good news. And the bond market rallied like crazy. And that's your microcosm from a domestic economic standpoint. Forget Japan. That was the microcosm. The Friday, the early month read on employment showed you what's coming down the pike, which is an economic disappointment. And that's not going to fit too well for a stock market priced for double-digit earnings growth. But it is going to pave the way for a more aggressive Fed easing cycle. So I think it's going to be very good news for the treasury market.
Fantastic breakdown. I want to talk about gold here. It's one of the only assets that held quite strong, that and treasuries, when the rest of the market was selling off. Whether that's really a salient data point or not, who knows? But I think both of you are the perfect people to talk about gold without any hyperbole, because you're not major mega bulls, perma bulls on gold. A lot of the people I talk to are of the the world's ending every day and gold's going to $10,000 variety. So I think it's refreshing to get both of your takes on how you see gold currently positioned, how you see it playing a role moving forward. Michael, I'll start with you.
Without hyperbole? Have you seen my X posts? Are you kidding me? Come on. I'm like as hyperbolic as it gets to play with the algorithm. Listen, I've been saying for aggressively I said it in April. I've been saying it again more recently. I keep putting in bold and italics. Gold is sending a warning. Look, big money does not short. Big money needs to be long only. So if big money is worried about correlation, which gets worried about correlation at a cycle shift, and they have to be long only, they don't have that many options to be long only and non-correlated, to lower their internal correlation of their portfolio. Anybody that thinks that 60-40, as an example, is diversified is wrong, because 60-40 is like 95 R squared against the S&P, right? It's still correlated to the factor of beta, right? Because there's credit risk in the 40. So to the extent that big money has been positioning into gold for its non-correlation behavior, then gold has been sending a warning, whether it's because of geopolitical risks or cycle changes or what have you. It's a diversifier, right? Big money wants diversification when things are turning. They want correlation when things are bottoming, right? Now, I thank you for making that point about neither of us are the type that go, oh, gold's going to go to 10,000 and all these like nonsense price predictions. The one thing I will say about gold here is I remember very well. I used to write on MarketWatch.com. I was one of their top writers for a few years. And back in 2011, 2012, whenever I would put a piece out on gold that was maybe negative, the gold bugs would come out in droves and attack in the comments. They were the Bitcoin maxis of today. Same types of narratives and same types of fervor and aggressiveness was happening with gold bugs back then, as you saw with Bitcoin in the most recent cycle. I don't see that now. I don't see that fervor. I don't see that excitement, right? I can't quantify it, but I get a sense that there's absolutely no excitement around gold from it, despite what looks like we're on the verge of some kind of breakout with these new highs. And I always go back to this point that trends persist on skepticism. They die on conviction. I don't see conviction in gold. So I look at gold, I say to myself, you know what? That probably does continue to rally meaningfully. At some point, people will chase it, and then the turn comes in. But anybody that's looking at gold, I think, needs to look at it from the standpoint of diversification as opposed to from the standpoint of FOMO.
Yeah, very well said, David. Last time I spoke to you, you said you thought the gold market had changed and that the market is now starting to see gold as, I believe you said, a currency without counterparty risk. Do you still see that in regards to the gold market? And what are your thoughts on the role that gold is going to play moving forward?
Yeah, I mean, gold is a currency that is no liability of any government, and it's not it's not Bitcoin. You know, everybody calls Bitcoin digital gold, but Bitcoin is correlated with the risk on trade. And if you believe otherwise, that this is digital gold, Bitcoin has 20 times the volatility that gold has. So I don't recommend it to my clients, except for those people that have ice in their veins. I gave a speech not too long ago, and I was asked, it was before Mother's Day, and this gentleman said, I feel like buying some Bitcoin for my mother for Mother's Day. What do you think? So I said, well, if you truly love your mom, you might want to do a barbell trade and pair that with a pacemaker. So the gold, look, I was saying at the time, that's right, because gold was hitting new highs in every currency terms, and its complexion was changing away from being part of the commodity complex to really becoming a currency on its own. Now, the two driving factors for gold, and I'm not going to get into central bank buying or the People's Bank of China. I'm not going to talk about the dowry season or income growth as a driver from a fund flow perspective out of India. But the two major correlations are working in your favor if you're bullish on gold and bullish on the gold mining stocks. Real rates coming down. Gold is inversely correlated to real interest rates. It doesn't pay you a coupon, so the opportunity cost of holding gold goes down. And it always does well in a bear market on the US dollar. And I think that the US dollar, which is topped out and rolled over, will continue to do so because the Fed, after having raised rates far faster than everybody else, is now going to play catch down to the other central banks around the world. Many of them have already started cutting interest rates in Europe and in Canada, and the Fed will play catch down. So rates coming down, especially real rates coming down and the dollar going down, that is just a perfect combination for an ongoing bull market in bullion. So I remain steadfastly positive just based on those relationships alone.
So the narrative of a commodities super cycle has been fairly pervasive over the last few years. There's been a lot of talk of a coming rotation from overvalued tech and AI stocks to hard assets seen as all but inevitable by many. So I guess if you believe that thesis, why not just go all in on commodities and wait for that thesis to play out? How do you both view the whole commodities super cycle narrative? A lot of people I talked to said it's going to be all commodities from coal to uranium to oil to copper. Do you view it that way? Is it more complex than that? And do you think maybe some caution is warranted for those who are just thinking of going all in when they hear these types of things? Michael, your thoughts?
I think all in is always a challenge because you might have your conviction and think you're a long-term investor, but that gets challenged if you're all in and it doesn't work when you get all in. Listen, I'm bullish on commodities. I've seen the same and referenced the same type of data around commodities to equities ratio, lack of investment in the space, supply and demand mismatches. To the extent that you have a super cycle, I think you probably need to have China because that was the primary driver of the super cycle, pre 08, you can argue. I don't know. I think the most bullish case you can make around commodities is the reality that there's a lot of infrastructure that needs to be repaired and rebuilt globally. Some of these estimates are outright outrageous in terms of what needs to be done in the US in terms of crumbling infrastructure and building out an actual real infrastructure in a lot of emerging economies. The challenge there is how do you really do that when your starting point of so much government debt is as high as it is? That's where I think it gets to be a little bit more nuanced in terms of that demand driver. But I tend to, in general, from a long-term perspective, favor the asset classes which nobody cares about in the current cycle. I always go back to the point that the biggest returns don't come from the middle of the trend, they come at the turn of the trend. So you have to have a little bit of a leap of faith to perhaps buy into commodities here. It's a lot easier to have faith when you are not just worshiping one one god and you're diversifying your religion by having more than just commodities in a portfolio. But I do think there is a legitimate longer term case there. I just think it's going to be a lot more challenging than people realize.
And David, your thoughts on how you see commodities performing up ahead? I know you're bullish on gold, obviously. Maybe your thoughts on silver, and if there's any other commodities in particular that stand out to you as presenting an attractive value proposition right now.
Well, I happen to like silver a lot as well, and that was my last trade was actually last week. I bought a bunch of silver coins and bars, and but gold and silver are pretty well the same trade. It's just a matter of, what you want to do is when a gap opens up that's above the norm, but that's really piling into the same sort of trade. Silver, of course, has more industrial characteristics than gold does, and gold happens to be more malleable than silver, but it's part of the same trade. Commodities, broadly speaking, quite a bit different. I said before, gold is really behaving more like a currency, is less like a commodity. When I hear the words commodity supercycle, I tend to run for the hills because the last time we heard that terminology was in the spring and summer of 2008, and you knew what to do. I think there is a strong case for a secular bull market in basic material in general. And if you look at any supply demand framework, you're going to see that most commodities will be in a supply deficit for many years to come, and that should be supportive of the price on a secular basis. Whether it's talking about EVs or we're talking about fighting climate change or even AI, big users of power, and the commodity demand on a secular basis will be pretty solid and bump against these supply constraints from what Michael has said is really years, if not decades, of neglect from a ramping out of the capital stock in this particular sector. So I'm long-term bullish. I think that the commodity space is something that is a buy and hold, but if you're going to buy it, you have to hold it. You can buy it on dips, get better buying opportunities. So I am a long-term commodity bull, admittedly. However, it's not going to be a smooth ride, right? It's not going to be without its corrections. And we've already seen just in the past few months a whole range of base metal prices, even copper that was red hot, came under downward pressure. The foodstuffs have come under downward pressure, the textiles. But my point is that if you have a 5 or 10 or even 20-year perspective, if you want to think about buying something that makes sense for your children or grandchildren, having part of your asset mix in the commodity space makes a lot of sense because if you have that time horizon, a secular bull market's going to play out very well. But keep in mind that I do have a sense that a recession is coming. I haven't thrown in the towel like everybody else has because I'm not tempestuous and I'm not impatient. and I'm willing to admit when I'm wrong. But just because I'm wrong on timing doesn't mean I'm throwing in the towel. I had lots of time to throw in the towel in 2007, and I didn't, because I still had quite high conviction, which I still do, which is basically quite simple. The business cycle is not dead. The business cycle has not been repealed. And in a credit-driven economy like the United States, interest rates matter, but they operate with long and variable lags, which we all know. But there is no get-out-of-jail-free card from the most acute tightening cycle since the Volcker years of the early 80s. So delay does not mean derailed. So if I'm right on the recession call, commodity prices will go down. But they're not going to go down as much as they have in the past. Where in the past, say in a recession, they might have gone down 20 or 30%. Maybe they'll go down 10 or 15%. I think there's just a firmer floor in a bear market or a correction or recession, a firmer floor under the commodity space than there used to be. But if I'm right on this recession call, you're going to have a nice 6 to 12 month span to look at the commodity space and buy it at more attractive price levels for the future, for the next 3, 5, and 10 years. And that's how I'm looking at it. But a long-winded way of saying, yes, I'm secular bullish, but cyclically right now, we'd be waiting for a better buying opportunity.
Fantastic thoughts from both of you today. This has been a great conversation. Before I do let you go, Michael, tell us about the lead lag report, where people can find that, and if there's anywhere else you want to direct people online, feel free.
I appreciate that. On Substack, leadlagreport.substack.com, on X at leadlagreport, YouTube at leadlagreport, Instagram at leadlagreport, LinkedIn, good old me. I try my best to frame things, especially on X, in colorful ways, for lack of a better way of saying, because that tends to get the attention. But a lot of the work that I do is purely quantitative. I am as skeptical as Mr. Rosenberg on a lot of things that people reference that have predictive power, because I've back tested a lot of different things, and I know most things don't really matter or work. So hopefully that natural dose of skepticism is helpful to those that subscribe on leadlagreport.substack.com.
Great. Well, that link will be in the description below for people who want to check that out. David, tell us about Rosenberg Research, where people can find that, and if there's anywhere else you want to direct people online, feel free.
Sure. Well, we produce daily reports, weekly reports, monthly reports, quarterly reports, and we cover all geographies and we cover all asset classes. And we don't just get into the weeds on a day-to-day basis on data analysis, which is critical, but we also look at the world 60,000 feet up in the air, and we write a special report on something topical and important at least once a month. So I do preach diversification. It's not a 15-letter dirty word. And we are diversified in terms of the product line that we offer to our clients. You can simply just Google Rosenberg Research and go surf our website, and right there you can sign up for a free 30-day trial, or you can just contact one of my client service personnel at information@rosenbergresearch.com, and we'll get you signed up right away, and you can kick our tires and taste the smorgasbord, and then hopefully after the 30-day free trial, you'll find some value in the material that I produce.
Great. Well, I'll put a link to Rosenberg Research as well in the description. Gentlemen, thank you once again for coming on the show. It has been a fantastic conversation, and I definitely hope we can do it again.
Likewise. Thanks for having us.
Likewise. Thank you, David.